everyone. In this video, I'm going to be discussing balanced price ranges and how you can take advantage of that in your trading. And I'm going to be doing that using an example from the E-mini S&P and the price action on Wednesday, 25th January. So if that's something you're interested in, let's jump right into it. So what's a balanced price range? Now, very simply, a balanced price range is created when you have two overlapping fair value gaps. Okay, so if you look at this chart we have here, we have a fair value gap. So from this candle's low to this candle's high is one fair value gap. Then from this candle's high to this candle's low is another fair value gap. Now, the point at which those two fair value gaps overlap is known as a price window. Okay, so fair value gap number one and then fair value gap number two. Where they overlap, which is what I've annotated here, is known as a price window. Price returns to that price window and moves away aggressively. This price window becomes a balanced price range. Okay, now balanced price ranges typically, when price returns to a price window that becomes a balanced price range, price tends to move away very aggressively. Okay, now that doesn't necessarily mean you want to just go long or go short whenever you have overlapping price windows that become balanced price ranges. No, they need to be in line or in sync with the underlying market narrative. What is the narrative here? The narrative here on the daily chart, we've had a short-term shift in market structure, right? We've had a shift in market structure here. Price broke above that swing high aggressively, creating a fair value gap here. And then price returns into the fair value gap. It returns into a discount of this range. This range to this high, price returns to the 618 perfectly, right? And when it does, it creates a fair value gap to the downside. And then from the 618 level, tapping the fair value gap, it rallies, creating another fair value gap. The underlying market narrative is we're bullish. We're looking for higher prices. And we have an overlapping price window. So what we do is we anticipate price coming back into this price window, turning this price window into a balanced price range. And once that happens, we anticipate that price is going to move away aggressively, right? Once price comes back to these overlapping fair value gaps, this price window is said to be a balanced price range. So how can you use that in your trading? Now, let's jump down to the 1 hour. Now, on the 1 hour, what we see is within the price window that became a balanced price range, we have a fair value gap. All right, we have a fair value gap. That's the first point. Let's drop down to the 15-minute chart. On the 15-minute chart, what do we see? We see relative equal lows. Price came down, rallied up, and came down again, and then rallied up aggressively. What's retail going to be seeing this as? They're going to be seeing this as support. So if retail is going to go long in here, they're going to be putting their sell stops below these lows. So price drops down, takes out the relative equal lows, takes out sell side liquidity, taps the 1 hour fair value gap. This 1 hour fair value gap is within the price window, and this happens during the New York AM kill zone. That's narrative. So we have a lot of things stacking on top of each other and giving us extra confluence that this should see a smart money reversal. Okay, so we take our sell side liquidity, we tap into the 1 hour fair value gap, we overshoot it by a little bit, we tap into the price window, we anticipate that once we've done this entire price window is now a balanced price range, and that typical behavior of price once a price window has become a balanced price range is that price is going to look to rally or tank aggressively. Okay, so that's the narrative we have from the 15 minutes, from the 1 hour, from the daily. We drop down to the 5 minute. do we see? On the 5 minutes, after we took out the sell stops, tap the 1 hour fair value gap, we create a short-term high. And in the kill zone, we break that short-term high aggressively. And we leave behind a 5 minute fair value gap. That's your long entry. You can go long right in there. Okay. And where do you target? You target the relative equal highs, and you can target the high of the day that was formed during the session. Price rallies up, stalls, and then bolts aggressively, creating an order block. You can pyramid your position in here and then look to take partials here and here. So that's how you would use a balanced price range um, in your trading. So to recap, on the daily, two fair value gaps that were overlapping. Now, we anticipate that price is going to want to return back into those two fair value gaps, the price window that is created from the two fair value gaps. We anticipate that price is going to want to return back into it and balance that range out. Once price does that, typically price is going to move away aggressively from the balanced price range. And we look for opportunity within the context of the underlying market narrative. And so dropping down into a 15 minutes, we have sell side. If smart money is going to go long, they're going to look to pair their long entries with sell stops. They're going to look to buy those sell stops. So we take out sell side, allowing smart money to do what? Accumulate long positions in here. We take out sell stops, tap the 1 hour fair value gap, which is within the balance, which is within the price window, which is now a balanced price range since prices returned into it. So on the 5 minutes, we have a shift in market structure after sell side has been taken. Fair value gap created. You can go long in there. There's rallies, stalls, 5 minute order block, pyramid your entry, partial here, and you can look to take some more partials when price reaches into these fair value gaps at the top. Hope you found this video insightful, and until I talk to you next time, be safe.